Welcome back to Talk Tickers. Listen, today we are doing something a little bit different. Usually we look at a sector or a broad trend or maybe a big merger.
Yeah.
But today we are going right into the belly of the beast.
We really are.
Yeah, we're doing a forensic deep dive into a single earnings call that has the market absolutely losing its mind right now. We're looking at Opendoor, ticker symbol OPEN, and their Q4 2025 results. Our source material is the earnings call itself and the accompanying shareholder deck, and our mission today is to figure out if this company is actually pulling off the impossible.
It's one of those situations where I've been staring at screens for 20 years, and it is rare that you see a reaction quite like this.
Right.
It's a case where the surface-level numbers tell one story, a pretty ugly one, frankly, but if you actually pop the hood and look at the engine block, you see something completely different.
Exactly. And we need to talk about it because before we even look at the numbers, we really have to set the scene for you. Context is everything here. Because leading up to this call, this stock was, let's be honest, it was roadkill.
Yeah, run over, backed over, and run over again.
It was looking incredibly grim. Over the last 3 months leading up to this release, the stock was down roughly 31%. Sentiment wasn't just low, it was subterranean.
People were writing the obituary.
Totally. I saw articles basically saying, is this the end? Has the iBuying experiment officially failed?
Because the narrative was just set in stone at that point. The prevailing wisdom on Wall Street was that the business model simply does not work in a high-rate environment.
Which makes sense on paper.
Right. The argument was always, you can't buy houses with borrowed money, hold them while paying 6% interest, and then flip them for a profit when buyers are broke. The math just doesn't work.
And then the earnings drop Thursday afternoon. And we see this massive, violent vibe shift. Immediately post-market, the stock pops 17, maybe 18%.
Huge.
We're talking about a move from around $4.65 to nearly $5.50 in a matter of hours.
Which, for a company of this size, and specifically for a company with this much short interest, is a massive move. That is a face-ripping rally.
So the core question we are trying to answer today, this is what we're going to spend this deep dive unpacking, is simple. Is this just a dead cat bounce?
We should probably define that for the uninitiated, because we throw that term around a lot.
Yeah, let's do that.
Yeah.
What exactly is a dead cat bounce?
It's a gruesome visual, but it's a standard market term. The idea is that even a dead cat will bounce if you drop it from a high enough height.
Right.
Basically, if a stock drops 90% and then rallies 20%, it doesn't mean the company is saved. It just means short sellers are covering their bets or people are buying the dip for a quick trade. It's a temporary recovery in a dying asset.
So is this just a relief rally because they didn't file for bankruptcy? Or, and this is the bull case we need to look at, is Opendoor 2.0 actually working?
That is the multi-billion-dollar question. And to answer it, we have to look at what I like to call the tale of two numbers. Because if you just glanced at a headline on your phone, you might have panicked and sold everything.
Oh, absolutely. Let's talk about the ugly number first. The GAAP EPS.
Right. GAAP earnings per share. This is the official accounting number.
It came in at a loss of $1.26 per share. Now, hold on. Caused the consensus, what the smartest analysts on Wall Street were expecting was a loss of only 11 cents.
Yep.
So they missed by over $1. In normal times, if you missed earnings by $1, your stock goes to zero. You get delisted.
The CEO gets fired before the call ends.
Exactly. So why didn't the stock crater? Why did it go up?
Because the market is smart enough, usually anyway, to look past the accounting noise. We have to explain why they lost that $1.26.
Please do, because a loss is a loss to me. If I lose $1, I don't have that dollar anymore.
Well, not exactly in corporate accounting. That $1.26 loss wasn't because they were burning cash selling houses at a discount. It wasn't because operations were bleeding.
Yeah.
It was almost entirely due to a non-cash loss from refinancing their convertible notes.
Okay, stop. Convertible notes,
Yeah.
refinancing. You are losing me. Break this down like I am 5 years old.
Yeah.
What actually happened?
Okay, let's simplify. Imagine you have a mortgage on your house. You owe the bank $100,000. But the terms of that mortgage are really annoying. Maybe the interest rate is weird or it's due really soon. You want to get rid of it.
Like I want to swap it out.
Right.
Yeah.
So you go to a new bank and say, I want a new loan. But to get out of the old loan, maybe you have to pay a penalty. Or, because of the way the bond market works, the technical value of that old debt on your books was lower than what you paid to extinguish it.
Right.
So on paper, you take a massive hit. You technically lost money to swap the debt.
Right.
But did you actually write a check for that entire amount today? No. Did it affect how many houses you sold? No. Did it change the electric bill at headquarters? No.
So it's a balance sheet maneuver. It's moving money from the left pocket to the right pocket and paying a fee to do it.
Precisely. It's accounting gymnastics. It cleans up the balance sheet for the future. It pushes the debt maturity out, which is good. But in the current quarter, it looks like a massive loss.
Okay, so investors looked at that $1.26 and basically said, fake news.
Essentially, they stripped it out. And when you strip that away and look at the adjusted EPS, which is what actually tells you how the business is running day to day, they came in at a loss of just 7 cents.
And the expectation there.
The expectation was a loss of 10 cents. So if you ignore the debt swap, they actually beat on the bottom line. They lost less money than Wall Street thought they would.
Okay, that makes perfect sense. But you can't just cut your way to growth forever. You have to sell stuff. Let's talk about the top line. Revenue.
This is where the excitement is. Revenue came in at $736 million.
Which is down 32% year over year. Again, playing devil's advocate here. That sounds bad. The business is shrinking.
It is shrinking, but it's shrinking less than people feared. The street was only expecting about $594 million, so they beat revenue expectations by a massive margin.
That is a huge gap. How do you beat revenue by that much when you literally have fewer houses to sell?
Velocity. And this is the key word for this entire deep dive. If you take one word away today, make it velocity. They are selling homes faster than people thought they could.
Explain that relationship for us.
Okay, think of Opendoor like a grocery store. If you have a banana on the shelf, you want to sell it before it turns brown. If you sell it in 2 days, you can buy another banana and sell that one too.
Right.
In the same amount of time, you sold 2 bananas with the exact same amount of shelf space.
Got it. Turnover.
Right. Opendoor had less shelf space because they had less inventory. Ending inventory was down to 2,867 homes. Compare that to the prior year where they had over 6,400 homes. They have less than half the inventory they used to have.
They are really slimming down.
Drastically. But even with half the inventory, they generated way more revenue than the models predicted because they turned that inventory over faster. They aren't hoarding houses, they're flowing them through the system.
And that's the Opendoor 2.0 thesis, isn't it? It's not about being a massive corporate landlord.
Exactly. The old model, let's call it Opendoor 1.0, felt a lot like a prop desk at a bank. They were taking massive directional bets on home price appreciation.
Yeah.
They'd buy a house, hold it, do some renovations, and frankly just hope the market went up 5% while they held it.
Which works great in 2021 when everything is just going up to the right.
And it is an absolute disaster in 2024 when things are flat or down. Opendoor 2.0 is different. They want to be a market maker.
Like a stock exchange.
Yes. They want to provide liquidity, buy it, fix it, sell it, ideally in 30 or 40 days. They don't want to bet on appreciation. They just want to capture the service fee and the spread.
So they're just greasing the wheels of the transaction.
Right. And the fact that they cleared so much inventory in Q4, specifically the old legacy inventory hangover, is why the market is cheering.
It feels like they're finally clearing the decks, getting rid of the bad bananas.
That's exactly what it is. And investors are pricing in the future, not the past. They are looking at the clean operating signals, that revenue beat, that adjusted EPS beat, and they are ignoring the debt-related noise.
All right, let's pivot to the strategy itself, because the CEO, Cass, right out of the gate on this call, he didn't mince words. He didn't come out with the usual corporate fluff about challenging macro headwinds and synergies.
No, he did.
He basically pulled out a report card.
He literally did. It was incredibly refreshing. He talked about a green, yellow, red spreadsheet. He said, I told you we had a 4-step plan. Let's grade it.
I love that. It's very accountable. But I have to be skeptical here because every CEO says they're doing great. Is this just him marking his own homework? Or is there real substance behind these green grades?
That's a fair cynicism to have. Let's look at the 4 steps he laid out, because they really define whether this company lives or dies over the next 2 years. Step 1 was break even.
Okay.
Their goal is to be adjusted net income positive by the end of 2026.
Okay, adjusted net income. That's a lot of qualifiers.
It is, but here is the quote that actually matters. He said, the goal is to reach that state so we never have to raise equity again.
Whoa, stop. Never raise equity again. That is a bold statement for a company that has been burning cash like a bonfire for 3 years.
It is incredibly bold,
do we actually believe him? Because if the housing market turns south next month, if rates spike to 8% again, that promise just evaporates, doesn't it?
Of course, it's a target. It's not a blood oath guarantee, but the fact that he is drawing that line in the sand tells you where his head is at. He knows that dilution is the ultimate enemy.
Yes, shareholders hate it.
He knows they are tired of getting watered down. He is signaling that they have enough cash on hand to bridge the gap to profitability if they just execute.
Okay, so step one is stop the bleeding. What's step two?
Step 2 was velocity. We touched on this. He claimed they've increased acquisition velocity by 300% since September.
300%. That sounds dangerous. If you're driving a car and you suddenly speed up 300%, you usually crash.
That's the risk, right? But let's look at the base numbers they're working from. They were coming off a near standstill. At the end of Q3, they were barely buying anything, maybe 128 homes a whip. Recently, they bought 537 homes in a single week.
Okay, so they are back in the game. They aren't just sitting on their hands waiting for the market to fix itself.
Correct. But your point about danger is totally valid. Ramping up volume that fast tests your internal systems. Can you inspect 500 homes a week accurately?
Right.
Can you price 500 homes a week accurately? We'll get to the October cohort in a minute, which suggests the answer is actually yes, but it's definitely a high wire act.
What were steps 3 and 4 on his scorecard?
Step 3 was direct-to-consumer focus, so getting people to come straight to the website rather than through partners. And step 4 was becoming capital light, pushing this new Cash Plus product.
We're going to dig into Cash Plus in a bit because I think that's actually a brilliant financial engineering move. But I want to talk about the vibe of the company first. You mentioned the CEO's tone. He used a very specific word to describe the culture. He called it wartime.
Wartime, yeah.
That is intense. That is not happy real estate tech company with ping pong tables in the break room. That is, we are fighting for our lives.
It is. And honestly, for a company down 90% from its all-time highs, it is wartime.
Yeah.
If they don't fix this, they go to zero.
Plain simple.
But he didn't just use the word as a cheap slogan. He backed it up with body counts.
Body counts.
Executive body counts. He said 18 people report directly to him right now, and 10 of those people, more than half, didn't even work there a year ago.
Wow. So he basically gutted the entire executive suite.
Completely. New CFO, new COO, new president. He said, look at the 10K filing. None of the names are the same as last year. He's building a completely new team for this Opendoor 2.0 mission.
It reminds me of that Elon Musk approach at Twitter, or even early Tesla. Flatten the structure, get the engineers in charge, and just move fast. If you aren't writing code or selling houses, get out of the building.
He actually used a Tesla analogy on the call. He said his job is to build the machine that builds the product. He views Opendoor itself as a product. And that engineering mindset is seeping into everything they do. They are demolishing what he called tech debt.
Okay, tech debt. I hear this term all the time in Silicon Valley. It usually just means old code we need to fix eventually.
Yeah.
But he gave some specific numbers that actually blew my mind.
Yeah, this wasn't vague hand-waving. He talked about their hosting costs, basically the AWS or cloud server bills. They cut those from $12 million a year to under $5 million.
That's more than a 50% cut. That money goes straight to the bottom line.
Right. And here's a crazier one. Their valuation model, the holy algorithm that decides what your house is worth, used to take 12 hours to run.
12 hours.
Yes. So if you feed in new data, you have to wait half a day to get a price to give to the customer.
That's an eternity in trading. By the time you get the price, the market might have moved. Or honestly, the customer has just gone to Zillow.
Exactly.
Okay.
They cut that runtime down to 5.5 hours. And he mentioned they reduced the scripts required to run the pipeline to just 50 lines of code. He said they are building features 90% cheaper now.
That is efficiency. That isn't just cutting costs. That's speeding up the entire metabolism of the company.
And that speed is critical because real estate is a slow-moving asset class physically, but the data moves incredibly fast. If you can make decisions twice as fast as the market, you have a massive edge.
Okay, so they have the new team, they have the new Skeed, they have the wartime general at the helm. But all of this is just talk if the unit economics don't work. And this brings us to the most technical, but arguably the most important part of this entire deep dive, the October cohort.
This is the holy grail.
The management was waving this data point around like it was a winning lottery ticket.
Right.
But I need you to explain this to me like I'm an idiot. What is a cohort? Why October? And why should you as an investor care?
Okay. In businesses like this, or in SaaS or insurance, You look at cohorts. You group all the assets you acquired in a specific time period and track how they perform over their entire life.
Think of it like a vintage of wine. You have the October 2025 vintage of homes.
Okay, so every single house they bought in October sits in this one bucket.
Correct. Now, historically, October is a terrible vintage. It is a traditionally bad month to buy homes.
Because of seasonality.
Exactly. You buy in October, you take a few weeks to prep the house in November, and you end up trying to sell it in December or January. And who buys houses in January? Nobody. Right. It's freezing. It's the holidays. Kids are in the middle of the school year.
Right. So usually if you buy in October, you are stuck holding that asset through the entire winter. Your holding costs go up, and you almost always have to slash prices just to move it.
Precisely. You bleed out slowly.
We call it the decay curve. Margins usually compress significantly for Q4 cohorts, but management claims that the October 2025 cohort, which is the first full group of homes bought under these new strict 2.0 standards, is on track to be the most profitable October cohort in company history.
The most profitable ever. In a real estate market that isn't exactly booming.
That's the claim. And the stats backing it up are seriously impressive. Resale velocity, meaning how fast they are selling these specific homes, is 2 times faster than the October 2024 cohort. It's a 50% improvement over 2023.
So they are buying them and flipping them twice as fast as they used to.
Yes. And this is where your skepticism should kick in. Usually when you sell things faster, you have to lower the price, right? It's a seesaw. You want speed. You sacrifice margin. You want margin, you sacrifice speed.
That is the classic trade-off in literally any retail business. Yeah. Margin versus velocity.
Exactly. But here's the magic trick they pulled off. They said margin degradation was flat.
Wait, explain that. How does that work?
So usually the first homes you sell in a cohort are the cream of the crop. You get the best prices for the best houses.
Makes sense.
As you get to the leftovers, the ones you've held for 3 months, 4 months, your margins get worse because you're dropping prices aggressively to get rid of the dogs.
The bad bananas again.
Right. They said for this October group, from the point where they had sold 10% of the homes to the point where they had sold 50%, the margins didn't drop. They actually improved by about 18 basis points.
That shouldn't happen. That defies the laws of retail gravity. How is that even possible?
It implies one of 2 things. One, they just got incredibly lucky and the market inexplicably surged in January, which we know from the macro data didn't really happen. Or 2, their initial underwriting was incredibly precise.
The algorithm actually worked.
The algorithm worked. It suggests that their pricing model, the initial cash offer they made to the seller, was dead accurate. They didn't overpay. And they are pricing the resale perfectly to clear the market without leaving a single dollar on the table.
This goes back to that structural shift they mentioned on the call. Moving from blanket price drops to AI-driven, home-specific pricing.
Right. In the old days, Opendoor 1.0, a human asset manager might have looked at a dashboard and said, okay, we have 50 homes in Phoenix that haven't sold in 30 days. Drop them all by 2%. It's a sledgehammer approach.
It's lazy.
It's massively inefficient. Now, the algorithm looks at each specific home individually. It says, okay, 123 Main Street has a weird layout, drop it $5,000. But 456 Elm Street is getting a lot of clicks on the listing, hold the price. And 789 Oak Street just needs a new photo of the kitchen.
It's surgical.
It is. And the result of that surgical approach is this massive drop in days in possession. It dropped 23% quarter over quarter. And the backlog, the homes they've had listed for more than 120 days, dropped from 51% of their portfolio down to 33%.
Well, that is a huge cleanup job. But I have to ask the bare question here. Is this actually sustainable? Just because the October cohort worked out, does that mean the November and December ones will? Or did they just cherry pick the absolute best data point for the earnings call?
That is the risk. One single cohort does not make a trend. But the expert insight here is that this proves the capability. It proves the machine can price risk better than it used to. The question going forward is, can they scale that machine up to 6,000 homes a quarter without breaking it?
That's right, because it's easy to be hyper-disciplined when you're small and buying 500 homes. Can you maintain that discipline when you're buying thousands?
That is the defining challenge of the next 12 months for them.
Let's talk about the engine behind this precision, because they kept saying AI. And I know every company says AI right now. If you sell toaster ovens, you're an AI toaster company. It's the buzzword of the century. But Opendoor gave a specific example that honestly blew my mind, because it wasn't about some generic chatbot. It was about paperwork.
You're thinking of the ops employee story.
Yes. Tell us about that, because that didn't sound like corporate speak. It sounded like a real structural revolution.
It was a very tangible, real-world example. So there's a process in real estate called seller disclosures. When you sell a house, you have to fill out these massive legal forms detailing everything wrong with the house. The roof leaked in 2018. The water heater is 10 years old.
And it's legally binding. If you lie on those, you get sued.
Exactly. So for a company like Opendoor buying at scale, this involves pulling data from property records, prior inspection notes, HOA documents, emails from the seller. It's an administrative nightmare. It used to take humans hours to do this for every single home. Just staring at screens, copy-pasting data from 5 different systems into a PDF.
Absolute drudgery. Soul-crushing work.
Exactly. And the CEO told this story about a non-engineer, someone on the operations team, not the coding team, who, in his spare time, over the course of one single week, built an AI workflow to handle it.
A non-engineer built this.
Yes. He used internal AI tools, probably something like a custom LLM wrapper they have, to build a system that queries the data warehouse, reads the inspection reports, cross-references everything, fills out the PDF, and just sends it for review.
And what's the actual result of that?
No humans in the loop. Zero. A process that took hours now happens instantly. And the CEO's point was, I didn't ask him to do this. There was no Jira ticket, no project manager. He just did it because it's wartime.
That is the Tesla mindset he was talking about. Everyone is an engineer, regardless of their title.
It is. And think about the margin implication there. If you can eliminate hours of manual labor per home, your cost per transaction plummets. That's how you get to profitability. You don't get there by raising fees on the consumer. You get there by removing the manual work internally.
And it's not just the back office stuff they're speeding up. They mentioned building a mortgage product in 10 weeks.
Which is frankly unheard of. I used to work in fintech. The industry standard for standing up a mortgage operation, getting the licenses, the compliance engines, the software integrations is like a year, maybe 18 months if you're fast. They did it in 2.5 months.
How is it even possible? Did they cut corners?
They claim they used AI to write the underlying code and manage the massive compliance checks required. They are launching this thing called Opendoor Checkout in 40 states.
What is that? Checkout. It sounds like buying a pair of sneakers online.
That is exactly the goal. It's a fully integrated buying experience. You find the home on the app, you hit a button, and you get the mortgage pre-approval embedded right there. It completely streamlines the friction of buying.
They're trying to make buying a house as easy as buying something on Amazon with one click.
That's the holy grail of PropTech. And they also mentioned this self-assessment app for sellers, which ties right into that friction reduction.
Right, where the seller takes the photos themselves.
Yes. Instead of Opendoor paying an inspector $400 to drive a truck to your house, climb on your roof, and crawl around in the dirt under the house, the seller just walks around with their phone. They take photos. The AI analyzes the photos and says, oh, there's a crack in the drywall here, or the carpet is stained over there.
Does that actually work, though? I mean, do people just take blurry photos on purpose to hide the damage from Opendoor?
Well, they said in January the number of assessments doubled, and half of them required 0 human visits.
Half.
Imagine the sheer cost savings on that scale. You aren't paying a guy in a truck. You aren't paying for his gas or his insurance. You're just processing pixels on a server. That is a massive reduction in overhead per acquired home.
It really feels like they're systematically removing the physical, real-world costs from real estate. They're digitizing the physical world.
That's the only way the unit economics work at scale. You cannot have humans touching every single part of the transaction. If you do, you're just a traditional brokerage with a slick website. To be a true tech company, the software has to do the heavy lifting.
Let's talk about the products themselves, because they're changing what they sell, not just how they sell it. This Cash Plus product seems to be a huge part of the 2.0 strategy.
This is crucial for their balance sheet. And it directly addresses the biggest criticism Wall Street has always had of the iBuying model.
Which is capital intensity.
Right. In the old model, Opendoor buys the house for $500,000. They wire $500,000 of their own or borrowed money. They take 100% of the risk. If the market crashes the next day, Opendoor holds the bag.
And Wall Street hates that. It's way too risky when rates are volatile.
Cash Plus changes that dynamic completely. It allows the seller to choose. Do you want all your cash right now? Okay, we'll buy it outright, but we charge a higher fee, say 7 or 8% to cover our risk.
Okay, that makes sense.
Or the seller says, I think my house is worth more, and I'm willing to wait a bit. Opendoor says, okay, We will give you a cash advance, say 90% of the value now. We will list it. If it sells for more on the open market, you get the upside. If it sells for less, you take the hit. And we charge a lower fee, say 5%.
So the seller retains the market risk.
Exactly. It's a risk transfer. Opendoor becomes a partner in the transaction, not just a gambler taking the other side of the trade. They are lending their platform and their liquidity, but they aren't betting the farm on every single house.
And is it actually growing? Do sellers want that?
Explosively. They said it grew to 35% of contracts, up from 19% just previously. And because overall volume is up too, that represents a 600% volume increase in that specific product.
That is significant. It means a third of their business is now this lower risk, fee-based model.
Which vastly improves their return on equity. It makes the business safer, more predictable, and ultimately more scalable.
Speaking of scalable, I want to touch on the military angle they brought up. The Heroes Home Credit. $4,000 toward closing costs for service members.
Yeah, I flagged this too in my notes. On the surface, it looks like a nice PR move. Support our troops, right? And it is a good thing. But strategically, from a business perspective, it's brilliant.
Why is it so brilliant?
Think about the military lifestyle. What defines it?
Structure and, well, moving. PCS,
Yeah.
permanent change of station.
Exactly. Every 2 to 3 years, you get orders. You have to move from Fort Bragg to Fort Hood. You don't have a choice. And you usually have a very strict timeline. You have to report for duty on an exact date.
So you are basically the definition of a motivated seller.
The most motivated. The traditional realtor process. You know, put a sign in the yard, bake some cookies for an open house. Maybe it sells in 30 days, maybe 90. That is a nightmare for a soldier with active orders. They need absolute certainty.
And Opendoor sells certainty.
Exactly. We will buy it on this exact date. You will have the cash in your account. You can go to your next station without worrying about 2 mortgages. It fits the military use case perfectly. There are 400,000 PCS moves a year in the U.S. It's a recurring, predictable churn of people who need to sell fast.
And military families talk to each other.
The network is incredibly tight. If Opendoor captures that niche, hey, just use Opendoor, it's easy, I got my money in 3 days, that is a high-trust, word-of-mouth revenue stream that happens every single year, regardless of interest rates.
That's a really smart play. It's a niche, but a massive, highly targeted one.
And it fits their geographic expansion strategy perfectly. They mentioned they expanded from being in roughly a third of U.S. markets to nearly the entire lower 48 states in just 10 weeks.
Wait, 10 weeks. How do you expand a physical real estate footprint that fast? How do you hire local market experts in every town in America in 2 months?
You don't. That's the whole point. You use AI. They leveraged AI to automatically ingest data from 200 different local MLS systems. They didn't have to hire local teams in every single town. They just plugged in the data pipes.
So they can make an accurate offer on a house in a town where they don't have a single employee living there.
Essentially, yes. They can underwrite it remotely using the ingested data and the AI pricing model. If the numbers make sense, they buy it. They send a gig worker out to put a lockbox on the door. That is the true scalability of software applied to real estate.
Okay, this all sounds incredibly bullish. I feel like we are drinking the Opendoor Kool-Aid a little bit here. You have to talk about the forward guidance.
Yeah.
Because there was a definite warning in there. They warned that Q1 revenue is actually going to be down about 10% sequentially.
Yes, and this is important context so people don't get blindsided. We can't ignore the drop.
Right. If everything is going so great, why is revenue going down next quarter?
It's an inventory timing issue. Remember, they just spent all of Q4 clearing the decks. They sold off all that old, heavy inventory. So they are starting Q1 with a very small book of homes. The shelves are mostly empty.
So they basically have nothing to sell.
They have much less to sell. They are rebuilding the book right now. They're buying heavily. Remember that 300% increase in acquisition velocity we talked about. That's happening right now. But those sales won't actually hit the accounting books until later in Q1 or even Q2.
So it's an air pocket.
Exactly. It's a temporary dip while they refill the pipeline with fresh assets. But here's the silver lining they offered to soften the blow. They expect Q1 to have the highest contribution margin since Q2 of 2024.
Because they're only selling the good stuff now.
Exactly. The old low-margin legacy inventory is completely gone. The bad bananas are in the trash. What's left and what they are buying right now is the high-margin Opendoor 2.0 inventory. So top-line revenue dips, but underlying profitability actually spikes.
And the CEO, he had a very philosophical take on the stock price volatility when he was asked about it. He quoted a football coach.
Bill Walsh, the legendary 49ers coach. The score takes care of itself.
It's a great book, by the way. Highly recommend it to anyone listening.
It is fantastic. The philosophy is basically, don't look at the scoreboard, just focus on executing the individual play perfectly. If you execute the plays right, the score takes care of itself. His point to the analyst was, I can't manage the stock ticker. I can only manage the execution of the business.
And to back that up, he mentioned his own salary.
$1.
$1 single a year.
He said he is the most levered family in the world on Opendoor stock. If the stock doesn't go up, he literally doesn't get paid. He isn't taking a cushy $2 million base salary while the stock languishes at $5.
That is real skin in the game. That creates a massive alignment of interest with retail shareholders.
It does. He isn't there to collect a paycheck. He's there to multiply the equity value.
So, putting it all together for you, the buy thesis here seems to be that we are at a legitimate inflection point.
That's the bet the market is making. The thesis is the bleed has finally stopped. The tech debt is gone. The new unit economics are proven by the October cohort data. Now it's just a pure math equation of scaling it up.
But the risk remains.
Always. The risk is always execution. Can they scale volume back up to 6,000 homes a quarter without getting sloppy on the underwriting? Can they keep that wartime intensity when the stock is up 50% and people feel rich again? It's easy to be hungry when you're starving. Can you stay hungry when you're fed?
That is the ultimate challenge for management.
All right. We have covered the numbers, the tech, the strategy, the wartime culture. Now it is time for our favorite segment of the deep dive. The part where we take all this information and spin it into something actionable, or at least highly entertaining.
Disclaimer time.
Yes, please. Keep the lawyers away.
This is absolutely not financial advice. We are two voices doing a deep dive. Yeah. We are not your financial advisors. Do not trade based on this segment. This is for entertainment purposes only. Do your own diligence.
Okay, with the compliance gods appeased, let's hear it.
Imagine we are analysts at a hedge fund. We are pitching a wild idea to the investment committee. I call this trade the algorithmic liquidity arb.
Ooh, fancy name. What's the actual play?
The play is a classic pair trade. You go long Opendoor, ticker open, and you go short Zillow, ticker Z.
Spicy. You're shorting the absolute giant of the space. Why Zillow?
Think about the underlying business models. What does Zillow actually do at the end of the day?
They are a media company. They sell ads. They sell leads to local realtors.
Exactly. They rely on premier agent revenue. They sell your contact info to a realtor for $100 when you click on a house. But in a volatile rate environment or a super high price environment, what happens?
Transaction volume drops off a cliff.
Right. And clicks become incredibly expensive, and they convert poorly. People browse Zillow for real estate porn, looking at mansions they can't afford. But nobody is actually transacting. The leads are low quality, real estate agents are going broke, they stop buying leads from Zillow.
So Zillow's revenue quality degrades because their customers are hurting.
Correct. But Opendoor isn't selling clicks or page views, they're selling pure liquidity.
The ability to just get out of an asset.
Exactly. When days on market spikes, when your house has been sitting there for 90 days and you have to move for that job or a divorce or a military deployment, liquidity becomes a premium product. You will happily pay a fee to just be done with it.
So Opendoor becomes the market maker of last resort, but they do it at a profitable spread.
Yes.
Yeah.
So the trade structure is you go along the liquidity provider, Opendoor, who can turn a house in 45 days using AI. And you go short the ad seller, Zillow, who's entirely dependent on slow-moving realtor commissions. It's a bet on transaction velocity versus ad impressions.
It's a really compelling hedge. But you always have a kicker, don't you?
I do. This is the outrageous long-term play. 5 years from now.
Let's hear it.
Opendoor's new AI underwriting is getting so fast, 5.5 hours, fully automated, incredibly accurate, that eventually they don't even need to buy the houses to make money. They just license the price API to the big banks. They become the Moody's or the FICO of residential real estate.
Whoa. So the data itself becomes the product.
Think about it. If you are Wells Fargo writing a mortgage, why trust a human appraiser who takes 2 weeks, costs $600, and might be biased? Just API into Opendoor, get the true market clearing price instantly, and underwrite the loan. Opendoor makes a fee on every single mortgage written in America without buying a single brick.
That is outrageous. But if that valuation model is really that accurate, it's completely plausible. You're valuing the data monopoly, not the house flipping business.
Exactly. The house buying is just how they constantly train the model with real-world data. The model is the actual gold mine.
I like it. It's wild. It's highly speculative, but I like it.
All right, let's wrap this up. Recap for everyone listening.
Opendoor posted a messy GAAP miss, largely due to debt restructuring noise, but a beautiful operating beat on revenue and adjusted earnings. The 2.0 pivot, the extreme cost cuts, the AI integration is showing up in the hard data, specifically that crucial October cohort.
The CEO is running this thing like a software company, specifically like a wartime software company. He's got the engineering mindset, he's gutted the management team, and he's focused purely on velocity and unit economics.
And if that October cohort wasn't a fluke, if they can actually replicate that margin stability while doubling their speed as they scale, then the stock sitting at $5 right now might look very, very cheap in hindsight.
But, as always, execution is everything. We'll be watching that accountable green, yellow, red dashboard closely next quarter.
We will indeed.
I want to leave you with a final thought to mull over. If Opendoor's algorithm gets so good that a house can be priced and sold in an hour, does real estate stop being a fixed asset? Does your house just become a liquid security like a stock in your brokerage account that you can tap into instantly? It changes the entire concept of American wealth.
It's a wild thought.
Check the charts, ignore the noise, and we'll see you for the next print.